Good evening, everybody. Welcome to Dividend Stock Talk. This is James Gardino, your host, and we are going to be talking about dividend stocks and investing in dividend stocks for weekly and monthly cash flow. For those of you that are interested in a higher rate of return with a safe, secure investment, such as a dividend stock, now there's over 7,500 stocks on the stock market trading on a regular basis. There may be more, maybe less, but I'm not really, because every day the number changes. Some drop off, some get added, but it's right around 7,500. Now, half of those companies take the profits and they invest them back into the company themselves. So you don't see any appreciation, any return whatsoever until you sell the stock. Okay, why would you, that's an interesting question. Why would you put your money into an investment and not make it work for you, not get the return from it until you sell? And when you sell, you get your profit, but then you get your tax liabilities. I don't know. It's just one of those things. The other half of the companies trading on the stock market are dividend companies that share the profits with their investors. That's the main reason why the stock market came about in the first place. The stock market we know of today got its start back in the 1590s, 1580s, 1590s, when some Dutch businessmen got together and decided, hey, we want to create the biggest, baddest company the planet has ever seen. The only way they can do that is to assemble a huge amount of money to actually underwrite the undergoing of this new company that they wanted to start. In order to do that, they literally went door to door, knocking on doors. Hey, Joe. Anyway, selling shares of this new corporation, this new company, this new big, huge global entity. And it just so happened to be the Dutch East India Trading Company. And it reigned supreme for 198 years. This company was so huge, they had their own money. They had their own armies. They had fleets of ships. They literally hit every single continent. They went everywhere. Anyway, needless to say, in the 1600s, they got the idea, and they started out in the 1590s, and they finally start selling the shares in the 1600s. So 1602 is, as far as I know, is the earliest share that is still surviving, still around. Can you imagine that, a share from the 1600s? However, that's where the stock market got its start. Now, it was so successful that the Dutch East India Company, it averaged 198 years. The average return for 198 years was 18% per year. That's the average. Some years it was as high as 70 or 80% return on your money. So you give them $100, you get 180 back, or 80 back. I don't know. 18% average return per year. That's freaking awesome. I mean, they don't do that anymore, but I'm sure there's someone out there anywhere that's giving you a large percentage return for your money. But that's how the stock market got started, and they were the company and the entity was so successful. More and more companies did that. And they started out as being dividend companies, sharing the profits with the investors. I don't know when they started, let's take the profits and invest it back in ourselves. I don't know when that started. I really couldn't tell you. My specialty is dividend stocks, so I research dividend stuff. Anyway, all that being said, today is Wednesday, October 18th. It is 10:34. We are halfway through the week, hump day, whatever you want to call it. Let's jump on in and see what we're doing so far this week and maybe answer some questions. All right. This is our dividend on steroids ones. Now, we do basically trade 4 different strategies. One is just straight out dividend capturing. Now, dividend capturing is simply put is we look at a dividend company and we want to just grab the dividend and move on to the next one. We want to buy it, collect the dividend, and sell it for the same amount of money we paid for it or a little bit more, and then move on to the next one. How do you say? Because it doesn't always work with every dividend company. There's like 3,500 dividend companies out there, and most of them pay quarterly. Quarterly means 4 times a year. So can you imagine that? 3,500 companies paying checks 4 times a year. That's over 12,000 companies, so 12,000 situations of sitting there writing a check. Because someone's going to sit there and write the check or mail the check out. It could be automated, it could be all computerized, but somewhere, somehow, 1,200 times a year, or a little more, 12,000 times a year, dividend checks are being distributed to shareholders. Okay, so how can you get your share? That's where I came up with a 10 to 20 checks per month. It's very simple, because what a lot of people don't understand or misinterpret, they have this misbelief that you have to own the stock all year long in order to qualify for the dividend. Not so. You only have to be the owner on the date of record to be eligible to collect a dividend. The date of record, well, let me just, first of all, there's 4 dates you need to remember when it comes to dividend stocks. 1 is the announcement date. That's when the company itself announces what the dividend is, when it's going to be paid. 2 is the EX date. That is the last day the stock trades before the dividend's paid out. The 3rd date you need to remember, and this is the most important one, or the second most important one, is the date of record, or the settlement date, or whoever owns the stock on this date is eligible for the dividend. Date number 4, it's not really one you need to know, but it's, you know, it's kind of nice to know. It's the payment date. It's when they actually send out the check. Okay, so 4 dates: announcement date, EX date, date of record, and payment date. Okay, so if you want to collect a dividend, you have to buy it on or before the EX date. Why? Because it's the last day the stock trades before the dividend is paid out. And to be eligible, you have to be owner of record. And they have what is called a settlement period. If you buy the stock today, sell it tomorrow, you never really owned it. Okay? Hard to believe, but you don't. You have to own it for a minimum of 2 days. Okay? And then it goes through settlement. And then you are the registered owner. Okay. That all being done and said, the 4 strategies we have are dividend capturing. That's where we go buy the stock, collect the dividend, turn around and resell it. How do we do that? Well, we created some really nifty software that goes into the data stream, finds out all the particulars of the stock over the last 10-year period, because I want something, and I want to pass along something to my investor friends and my investor family that has historic performances to it. If you have 2 companies, one has been paying on a dividend consistently for 10 years, doing this for 10 years straight, and this company over here only did it once or twice, I don't know about you, but I'm going to go with the tried and true and the historic performance one. That's what the software does. It picks which is the best company to invest in at the moment in time. Every day there's anywhere between 1 and 100 companies paying on a dividend. So what the software does, it saves a lot of time, effort, and it does all the mathematical equations for you, giving you the odds, percentages, blah, 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 all that kind of nice, neat, fun stuff. But do you have to have that software in order to do this? No. It just makes it easier. It depends on how you value your time. So for $30 a month, it's simple. Just type in the stock symbols, and the software does all the work for you. You don't need it to do the strategy, because you can do it longhand, or you can just guesswork. But it's so much easier with the software. And that's why we have it in the first place, to make life easier. All right. Oh, so as I was saying, dividend capturing, buy the stock, collect a dividend, sell for a profit. The next one is dividends on steroids. Because I've been investing for over 20 years, and I found that certain dividend stocks have a tendency to move up coming into the dividend date. And that's what we call the run-up, or, lack of better words, other people jumping on the bandwagon. You know, people buy the stock just to collect a dividend. Anyway, dividends on steroids is the stock moves up a certain percentage point, and that's what how I got my first start with the dividends on steroids strategy. Next would be dividend investing. That's where you invest for the dividends equivalents. Now, what does that mean? Now, all these companies here are all dividend stocks because I don't invest in anything other than dividend stocks. Clorox has a dividend coming up, let's say, on the 30th, and it's like 50 cents. Now, I'm buying it today, which is the 18th, but the dividend doesn't come out to the 30th. Now, I only want the dividends equivalents, whatever the dividend is. Let's quickly go find out. I'll give you a quick synopsis. ACN. Now, what's today's date? Today's the 18th. No, we don't want to look at the 18th. We want to look at, let's say, the 31st. Okay, you have 44 companies on the 31st. Let's drag this up so we can see all of them. Click on right here, and that arranges them a certain way. TEP's offering a dividend of 94 cents. Okay, the strategy of dividend equivalents is the EX date is the 30th. So anywhere between now and the 30th, we want to buy this, and we want to collect that 94 cents. Now, do we want to wait until the 30th to collect that 94 cents? No. And you know why? Because the government just so happened to put a new tax on dividend income. They want to change the dividend income. They want to tax it a different way. So let's just invest and collect the money anyway. So instead of sitting waiting to collect a dividend, we jump in, depending on what the software says, how long does it take to get to that point, and then we choose that way. So like you have 44 companies. The software is very simple. You cut and paste all of these stock symbols into the software, and the software will actually tell you through the mathematical equations that it does. And trust me when I say this, it used to take me about an hour to do the calculations for each investment that I did. Now, I went into the historical performance. I looked 10 years ago. What happened this date? What happened? What was the opening of the day on the EX date? What was the close of the day? What was the high for that week? What was the low for that? Oh, it was exhausting. So doing that 44 times was aggravating. So a software, you can just cut and paste all these symbols in there, hit the button, and then it does all the calculations for you. How long is it going to take to hit the 94 cents? Great. In 2 days, that's better than holding up for the dividend. So anyway, we have a lot of choices that we can make. Strategy number 4 is where we use the dividend date, the EX date, as a precursor for spread trading with options. Yes, it is very complicated, and well, it's not really complicated, but it's complicated if you don't know what it is you're doing. Okay, that's like brain surgery is complicated for everyone except for brain surgeons because they've been trained in it and they've been doing it for a while. Okay, building a house, same thing. The average person coming out of elementary school can't do it, but someone who's been doing construction for years can. The options is the most profitable thing we do. Now we can get a bigger return, and I'm going to show you some of those in a little bit because we're going to look at only 2 of the accounts that I manage. I manage more because I use one account per strategy. Like this account I'll use exclusively for dividends on steroids. Okay, so it tells you what kind of return could I expect if I did this strategy. Now, if you watched all the videos, you'll notice that I don't do a lot of work with this strategy because it is a slower process for those of you who don't have a lot of time on your hands, but you do want a higher rate of return, a higher safe rate of return. Hey, if it's too much for you, put your money in the bank. They're paying 1%. Why not? I'm offering an opportunity to show you how to collect 1% per week or per month. 1% per month comes to 12% a year. 1% a week comes to over 50% per year. It's up to you. All right. I'm just doing this for educational, fun, entertainment. Whether you decide to do this or not, seek out professional help on your own. Make your own decisions. Take responsibility for your own actions. Let's jump on in and take a look at some examples. First on the list, we have Clorox. CLX. Everybody knows who Clorox is. The Clorox company. They started out the year right around 121. Quickly found a low of the year at 111. From the low of the year at 111, it took them a while to get up to the trading range of 135. It's between 130 and 137. It's like 135, and it should be going sideways for the last 9 months. Dropped down a little bit to stay in the 130 area. Now, where are we with Clorox? Clorox, we bought 300 shares at 131, and she just closed at 130.96, so we're a little bit below, and we got a target of for Clorox at 134. Okay, so we're down 78 bucks since it opened. DFS is the next one we're looking at. DFS starts the year out at the low of the year. It doesn't take long, about a month and a half, almost 2 months for it to find the high of the year at 73. It doesn't really have a good trading range in the 70 area because it seems to be, high of 74, low of 67, but it seems to be in that range for at least 4 months and slowly drops down to a range right around the 60 area where it trades about 5 months. And she's settling in at 65 at the moment. Now, DFS we've had for quite a while, and we collected quite a bit of dividends on them also. We collected dividends 3 times. We got 800 shares at 67, and she's at 65 at the moment. And we're looking, we might actually hit this target pretty soon, 67.18. Now, we collected 3 sets of dividends on this one, and it's quickly coming up to the 37.18 target mark, which is right about where we got it. So it goes back to that, buy, collect dividend, sell for what you paid for it. That way you're collecting the dividend, moving on to the next one. So we are with DFS. Profit for today was 600 bucks, but we're 153 in the positive with DFS where we bought it. And we now that could mostly be from dividends because we haven't reached our target price of 67.18, which is right about where we bought it in the first place. Yeah, 67.16, which is what our initial price is. Now we collected dividends, which is just 8 shares, 8 shares, 8 shares. No, doesn't really do very much for us, but it keeps us in the positive with DFS. Now Lowe's is the next one we're looking at. LOW. Now Lowe's is a dividend king. They've been increasing their dividends every year for more than 50 years. And that's why we got into investing in the first place. We want a return for our money. We want a spendable return for our money. You don't want to spend the money? Fine. Put it back in and, escalate your returns. Make it go a little bit faster. But anyway, with Lowe's, they start the year off at 69. Quickly found a bottom of 65. From there, back up to the 70 area, 70, 72, which you traveled about 3 or 4 months there, then jumped up to 82 area for a couple of months. Seems to be all over the place, but she's settling in at the $80 at the moment. Now Lowe's, we got Lowe's at 81.75, 500 shares. We got that last week. So we're in no great hurry to get rid of Lowe's because they get the dividend coming up probably next week. If we bought it last week, we'll most likely get the dividend up next week because we like to buy it 10 days ahead of time. Now, we haven't collected any dividends on Lowe's yet because it's a relatively new company. Not new company, but new to us. Macy's, our big loser, starts out at 35. From 35, doesn't take long for it to its high of there, 45. Now, 45 is the high of the year for Macy's. From there, it took about a month and a half to hit trading range of 30, 29.30. And it traveled in the 29.30 area for a good 5 months, dropped down to 23, traveled there for about 4 or 5 months, and then traveled down to 20, and then traveled for another 3 months there. Now, I say Macy's the big loser because we've had Macy's since February. Okay, we collected 3 dividends on February. We won't collect dividends on Macy's again until next year. However, when I say big loser, this is why. We made $300 off of our holdings, paper, because they won't, not profit, so you actually take it. $300 up today. However, we're still 19. It's almost $20,000 down from when we bought it in February. But look, we bought it in February, way over here, where it was in the 31, and we've been carrying it all this way. Now, the high of the year is 45. Now 31 is like 30% less than 45. Anyway, we want this baby to go back up 11 points. 11 points is a 50% increase from where she is today at 20. For it to go back up to 31, where our target price is, right here, 31.10, this thing has to go up 50% from the price of today. A 50% move for the price of today, that'll bring it up $10. That'll bring it up to 30. I wouldn't mind selling at 30, but no, I'm waiting for 31.10. And who knows, it may not even hit 31.10 this year. SKT. SKT, we've been holding this one for a while also. SKT starts out the year at the high of the year, 37. Quickly dropped down to 34, traveled that way, tried to break through that 37 again, but just couldn't. It seemed to be a little bit of resistance going past 37, which is fine and dandy. I wouldn't mind if it went back up to 37 and tried that resistance again. But fell down to 33, then it fell down to 32, which is where we got it at, and then dropped down to 26, and now she's down to 25, 24, which is where she's at today, 25.19 SKT. Now SKT, we got back in April, and we collected 3 dividends on SKT. But we got it at 32. And SKT, we're looking to get out 32.90, and she's at 25. So we're looking for a 7-8 point, which is 25% increase. It has to go up 25% for us to hit our mark. Anyway, needless to say, even with dividends on steroids, with the $28,000 loss that were incurred, paper incurred, because it's not really a loss until we actually take it, we are still at 5.7% return for the year, which is not bad. If you factor this back in, it's a nice return for the year with a very safe, slow strategy such as dividend capturing. It is basically a set it and forget it type of strategy. You buy it and you just leave it alone. We have it set up in a way. There's just a couple of clicks, boom, you're done. And you don't even look at your account until you get a message. I suggest people to get it sent to their email, and then from the email get it sent to their phone, because everybody has a phone nowadays, you know, a portable phone. So you sell off something and it gets sent right to your phone. So, cha-ching, you made money, good, time to do something about it. Okay, that being said, let's get out of here and let's go to our options. Okay, for those of you who don't understand options, options is nothing more than a glorified layaway, or hey, hold this for me, I'll give you some money up front type of deal. You go to Walmart, you see this cool toy that you want to get for your grandson or your son or your daughter, whatever, and you say, you know what, I don't have all the money now, but let me give you $10. Hold it for me for a week, and I'll come back at the end of the week and pay you for it. It's the exact same thing we're doing. Okay, we're buying it for a small amount of money. It's not really buying it, you're just buying the privilege of buying it at a certain price. You're not actually buying it. Okay, the first one on the list is CVS. I'm a little disappointed with CVS, only because there's a CVS in every major city in the country. So why did she drop from 80 down to 72 in the last week or so? CVS is one of those companies. Everybody knows who they are. Hey, go to CVS, pick this up for me, whatever. Starts out the year close to the high of 88. From 88, quickly falls into the trading range. Anybody can see this thing's going sideways. Between 76 and 81. Staying in that range. Call this range trading, channel trading, channeling. A lot of different words they call it. But she broke out of the range and dropped down to 74 just within the last couple of weeks. Now, a couple of big down days here. What was the news? The news was some insider, some CVS insider executive sold off $100 million worth of stock. Sold off $100 million worth of stock. CVS has taken the stand against the opiate abuse, the opiate drug abuse in the country. Those two headlines made this thing plummet from the 80 area, which it was at, down to where we are today in the 73, 74 area. And where do we have CVS? We got CVS at 80. However, I sold someone the privilege of buying it for me at 73.50 because I didn't think it would make that big of a jump this week, and apparently it did. So I'm selling it at a loss. Is it really a loss? Yes, it is, because I'm selling it at 73.50. I collected 26 cents. So if you add that onto that, that only brings me up to 73.76, and then I collected 50 cents last week. You add that in there, that brings me up to 74 something, 74.20 something. So yeah, I'm selling it at a loss. That's not what I'm doing in this strategy. That is what they call a covered call. Now, I'm only doing it just to get rid of it and to move on to the next one. I don't normally do that. Where are we with CVS anyway? Account statement, CVS right here. Our profit loss year to date is 3,900. Ouch, maybe I shouldn't have done that. Oh, wow. All right, we'll wait for it to go back up before we get out of it. Actually, we'll be out of it this week. That's not good. That's like one of my big losers of the year. That's not good. All right, anyway, can't win them all. I don't claim to win them all. And anyone who tells you they've won them all, lying to you. Okay, I take my lumps just like everyone else does. EPD. It showed promising in software. EPD. Started out the year at 27, quickly found the low of the year at 24. From there, about a month and a half, she found the high of the year at 30. From the 30, it's been a slow descent down to the 25, 26 area, which is where she's at today. Look at this, 4 down days in a row. Now, we got EPD the other day because it's showing promising, and we got the 26, 26.50. So I'm doubtful we're going to do anything with this one because we are at 25.48, and the only way we're going to make money on this one is if she goes back up to 26.50, which is way up here. I honestly can't see it doing that in the next 2 days. 2 days, Thursday, Friday. So we win some, we lose some. I believe that was like a 25% trade. We would have got 25% return on our money had it went through. And makes me a little uncomfortable. Alrighty then. That being said, GT is our next one. GT is Goodyear Tire. Goodyear starts out at 31, quickly finds the low of the year at 27, jumps back up to the 31 trading range for a couple of months, shoots on up to 35 trading range for 1, 2, 3, 4, 5, 6 months, drops back down to the 31, and from 31 she's in a nice steady uptrend to the 33 area where she is today. Now, where do we have Goodyear at? 32, 33. So we're in the money with Goodyear because as long as she stays above 33, we're going to make our profit. Okay, so we have 2 more days. Hopefully we have good news for Goodyear because Goodyear's got their dividend coming up in the next 2 weeks. Hasbro. Oh, I love Hasbro. Hasbro's been very nice to me. Let's see where we at Hasbro. Come on. ABCDFG H Hasbro right here. Hasbro, look at that. We made $9,000 off of Hasbro so far this year. You can't really tell exactly until we're out of this position because we got some money tied up with Hasbro. But so far, profit year to date, this is that profit year to date column right here. Hasbro, 9,000. Gotta love it. All right, let's get back to where we were. Okay, Hasbro looks good. Lowe's is next. As you see, I got Lowe's in both accounts. I'll do that often if I see a company that looks really good. Okay, Lowe's starts out the year, looks almost the exact same as Hasbro's share, up the Hasbro chart, doesn't it? Starts out at 70, quickly finds a low at 65. From there, back up to the 72 area for a couple of months. Shoots on up to 83 for a couple. Hey, I just did this a few minutes ago on the other one. But anyway, kind of all over the place. She's in the $80 area right now. And where are we with Lowe's? All right, we got a couple of positions with Lowe's. First of all, we bought Lowe's at $80.50, and we sold two options because we only had 200 shares. We sold those two at $80.50, so we'll be, if it stays above 80 to $80.50, then we'll be out of this position this Friday. Okay? And we also have the $81.50, which we're losing on. So if this thing doesn't go back above $81.50, we will lose the option money on Lowe's. That's not good. See, we're down almost 400 bucks on Lowe's. All right, last but not least is TXN, which is Texas Instruments. Texas Instruments starts out at 69, quickly finds a low of the year at 67. From there, it's a nice steady climb to the trading range of 80. Now she traded 80 for 1, 2, 3, 4, 5 and a half, almost 6 months. From there, it's a nice updrive to the 93, 94 area, which 94.20, 94.41 is the high of the year. And where are we with Texas Instruments? The 92.5, 93. So we're in the money still here. As long as she stays above 93 for the next 2 days, we'll make money off of Texas Instruments. Now, see, it could be deceiving because, as you see, it says we're down 100 bucks on TXN, but not necessarily so, because as long as she stays above 93, we actually profit on that one. All right. All that being said, what we're looking at now is answering any questions, and let's see if we have any questions. Okay, no questions. Gotta love it. So no questions means I can get out here early, and you guys can think of some questions and ask me later. Okay? Now, remember, it's your money. Do with what you think is best for you in your situation. Okay, there are a lot of different ways of investing. There's a lot of different strategies out there. Nobody's right, nobody's wrong. It's just information that's out there. You know, ask yourself the questions. Ask yourself the hard questions. What is best for me in my situation? What do I want? How much time and effort do I want to put into it? Because believe it or not, I'm on here for an hour every day showing people what I do. Now, I personally, my own account, I less than an hour a week. I know what I want, and I know how easy it is. I get it, I look at it, I find it, and I move on. I'm just here sharing my information because I think it's the right thing to do. You get to a certain point in life, I think you're morally obligated to share what you've learned over your lifetime, and that's what I'm doing. All that being said, this is James from Dividend Stock Talk. We are out of here, and I will see you tomorrow.